All right, let's talk about what's going on because right now in 2026, we're seeing a perfect storm brewing for the economy. It's this combination of, well, new protectionist policies on one hand and a sudden military conflict on the other, and it's shaking things up big time. And it has major implications for your wealth. So let's dive right in. I want you to look at this number, $2,510. Now, this isn't just some random figure I pulled from a spreadsheet. This is a real cost, and it's one that's about to hit the average American family hard. The big question is, where is it coming from? Well, it's pretty simple. It's the new annual cost of living that, you didn't vote for. You can think of it as a massive hidden tax. And this financial burden is the direct result of a really radical shift in economic policy. And you can bet it's hitting the budgets of middle and lower income families the hardest. In fact, the Joint Economic Committee is calling this the most significant tax increase in a generation. And it's not just one thing. It's being driven by two major events happening at once: aggressive new tariffs that are meant to protect domestic industry, and a sudden geopolitical crisis that has just sent shockwaves from the entire global energy market. So what does this all mean? It means we are facing what you could call a two-front economic war. You've got tariffs driving up prices here at home, while at the same time, a conflict overseas is throwing the global economy into chaos. Let's break down that first front. So, after a bunch of legal challenges, this new tariff scheme was put into place. The stated goal, of course, was to protect American industry, maybe even replace some income tax revenue. But the immediate consequence? A price shock that has just rippled through the entire consumer economy. And here's where you can really feel the impact. Just look at these price hikes. A PlayStation 5 used to be around $500. Now, it could cost you over $1,200. The base iPhone model has literally doubled in price. Even the basics, like imported coffee, are up 10%. But that last line, that's the one that's really striking: school violins. See, most of them are imported from China for just a few $100s. With these tariffs, schools just can't afford them anymore. And a domestic alternative? We're talking over $6,000. Music programs are literally being priced out of existence. It's just incredible. Okay, now for that second front. As if the domestic economy wasn't reeling enough from this tariff shock, a new conflict just erupted in the Middle East, and it's centered on the single most critical choke point for the world's entire energy supply. It all happened so fast. On February 28th, coordinated airstrikes began, and boom, Brent crude oil immediately jumped. By March 4th, Iran responded by blocking the Strait of Hormuz. That's the world's energy jugular right there. Oil shot past $120 a barrel. Regional production just plummeted. And what about here at home? Well, gas prices started climbing 5 to 10 cents per day. It pushed the national average towards $4 a gallon in no time. The speed of this was absolutely breathtaking. So, with this two-front war going on, how did Wall Street react? Well, with a whole lot of concern, let me tell you. Investors are now looking at a nightmare scenario for any economy, the very real, very scary possibility of stagflation. And the data from March really tells the story. The tech-heavy NASDAQ, it fell over 2%, pushing it into what we call correction territory. The broader S&P 500 turned bearish, which just means investors are expecting prices to keep falling. But meanwhile, as you'd probably guess, Brent crude oil absolutely skyrocketed, up 45% since the conflict started. The whole AI-driven rally we saw in 2025, it's being totally overshadowed by these rising costs. So what exactly is stagflation? Honestly, it's the worst of all worlds. You get the rising prices of a boom, but you also get the slowing growth and high unemployment of a recession. It puts the Federal Reserve in a totally impossible position, right? If they raise interest rates to fight inflation, they could just crush the economy. But if they cut rates to try and stimulate growth, inflation could spiral completely out of control. It's a real mess. And that brings us to the most critical question for every investor out there. In this kind of volatile environment, where do you put your money to keep it safe? Well, the answer in 2026 has been surprising, to say the least. It's sparked a fierce debate over what a true safe haven asset really is anymore. This slide to me shows a really fascinating historical divergence. For decades, gold was the undisputed king of safe havens in times of war. But in the 16 days right after the Iran conflict kicked off, gold actually fell 2%. And in that same period, Bitcoin, digital gold, it rose 7%. This is a major, major shift in how the market is behaving.
So why? Why did Bitcoin outperform? Well, there seem to be three key reasons. First, the approval of those big institutional ETFs created a sort of demand floor. You had major funds buying in, which prevented that classic retail-led panic sell-off. Second, its market is open 24/7, so it has constant liquidity. That allowed the market to price in the geopolitical risk in real time, even when the traditional stock markets were closed. And third, it showed this incredible ability to absorb shocks. With each new bit of bad news, its price volatility actually decreased, which really suggests the asset class is starting to mature.
Okay, so given this completely new landscape, what can you actually do to navigate the rest of the year? Let's walk through a playbook for protecting your wealth, looking at this from a cautious advisor's point of view. First things first, we have to understand the range of possible outcomes. The most likely scenario, sitting at 50%, is what's called an inflationary boom, where the economy keeps growing, but inflation stays stubbornly high. But look closer. Stagflation and recession each have a 15% probability. Now, while that's not the most likely outcome, a 15% chance of stagflation is a significant risk that every single investor has to prepare for. You just have to. So, what's the game plan? Here are 4 key actions to think about. First, adapt to structural inflation. That means seeking out real assets that protect you against your cash losing its value. Second, you have to reevaluate what a safe haven even is anymore. Consider a diversified portfolio that actually includes Bitcoin as a hedge. Third, focus on resilient companies. Businesses that have diversified their supply chain so they're not so vulnerable. And finally, keep a very close eye on the Federal Reserve. Any political pressure on them to lower rates could weaken the dollar and make hard assets look even more attractive. And we'll end with this question. The twin shocks of 2026, the tariffs and the war, they've accelerated a really fundamental shift in the global economy. From how supply chains work to what we consider a safe asset, the old rules are being rewritten as we speak. So the key takeaway here is to ask yourself, in a world where the very rules of money are changing, is your portfolio truly ready?